I believe this is going to end the same. And, people are going to lose a lot of money. But someone asked me yesterday, but you're not short. I'm like, no, I'm not. I learned my lesson back in 2000, trying to short companies like MicroStrategy and Cisco. And look, Julian Robertson shut down the largest hedge fund in the world at the time. Just let that hang in the air for a second. It was a $20 billion hedge fund back when $20 billion was a lot of money. And he literally wrote a letter to clients saying, I don't understand. Companies that don't make money should not, and these guys do make a little bit of money, but this company sells at 44 times revenues.
Fannie Mae economists have issued a revised forecast, predicting that the housing market stagnation could extend into 2024. This forecast remains consistent, whether or not the economy avoids a recession or manages a smooth landing in the coming year. The projection anticipates a continued lack of momentum in existing home sales, with sales likely to remain subdued and confined to a narrow range. Recent data from the National Association of Realtors reveals that existing home sales have already declined by 2.2% in July compared to the previous month, reaching an annual rate of 4.07 million units. Year-on-year, sales of previously owned homes are down by a substantial 16.6%. This decline in home sales is primarily attributed to significantly higher loan rates, a direct result of the Federal Reserve's rate hikes, which have made it increasingly challenging for Americans to afford homes and cars, as well as for businesses to finance expansions. Furthermore, essential expenses like rent, restaurant meals, and various services continue to rise in cost, even though the Federal Reserve has initiated 11 rate hikes since March 2022. Core inflation, excluding volatile food and energy prices, remains elevated despite these efforts to control it. In a video, Mark Yusko delves into the state of the U.S. housing market, mortgage rates, and other pressing macroeconomic concerns.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We live in amazing times. We live in a gamified system where, things can stay high longer than you like, except where's AMC right now? All-time low. If they didn't do the 10-for-1 reverse split, it's $1.41. GameStop, almost back to where it was 3 years ago. So these things do end. And, it's just this one is supported by not day traders, but the tyranny of the index fund that Michael Green and others talk about. That, every 2 weeks, a bunch of money has to go in to the Fangman stocks because they are cap weighted parts of the indices. And at least for the next 7 years, how many years we got left? 6 years. For 6 more years until the last of us baby boomers. My wife's the last year of the baby boom. And she's 59. So until that group stops turning 60, no, it's longer than that. It's 11 till she's 59. It's 12 years. In 12 years, all of us will be taking money out of the system. None of us will be putting money into the system because 71 and a half, you have to, start taking it out. And there's an echo boom that's big, but there's a bust in between. Gen X, Gen Y are not big enough. Gen Z and Gen A are big, but they're young. They don't have any money. And we're going to see what happens when there's $1 trillion of outflow from these stocks instead of trillions of inflows. Houses and stocks actually look like they're doing well as long as you don't price them in anything that matters. Like one of my favorite charts is stocks look like they're at all-time highs, give or take, but that's priced in dollars. We price them in gold. They're the same price as 1997. They look like that chart you showed of mortgage applications. Yeah, because the money just keeps getting devalued, which in theory makes my house price on Zillow look better. But we've talked about this before. My house doesn't grow. It doesn't get more efficient. It actually wears out. Houses are a wasting asset. They're not a growth asset. The money gets worse.
The recent slowdown in sales can be largely attributed to a sharp increase in mortgage rates, which reached a fresh 2-decade high last week. According to Freddie Mac, rates for the popular 30-year fixed mortgage surged to 7.23%, a significant jump from the 5.55% recorded 1 year ago and well above the pre-pandemic average of 3.9%. This rate hike represents the highest level for mortgage rates since 2001. This surge in mortgage rates not only creates affordability challenges for many potential homebuyers but also exacerbates another issue in the housing market: a limited supply. Sellers who locked in low mortgage rates before the pandemic are now hesitant to sell as rates remain near their 2-decade high. This reluctance leaves few options for eager prospective buyers. Mark Yusko offers further insights into the potential future of the U.S. housing market in light of these developments.
The housing index is down. And then they also do an affordability index. And this, this was a little cheesy, but they did a thermometer, like green to red. The whole country was red. I mean, affordability has fallen off a cliff, and that's what this purchase applications drop is telling you, right? Is if you're in a home, great, you can afford it, because we had that 13-year period of stupid policy where we took interest rates to zero even though we didn't need it, and we basically just stuffed people into homes. Okay, fine. But then you do the fastest rate increase in history, which, okay, Powell can claim a lot of firsts in history. This is the fastest rate increase in history, and we're right back to where we were 20 years ago. The difference is housing prices aren't the same as they were 20 years ago. So that's your point on the chart. Now, the only problem I have with your first chart is it's a terrible chart crime, right? 20-year charts have to be logarithmic scale. They can't be linear scale. So that rise looks much worse than it is, because it's just a double. 1,000 to 2,000 is a double, the same as, 600 to 1,000. Well, I guess 600 to 50, only 50%. But the issue I have is, yes, this is a horrible trend. And it's bad for the average American in particular. And that was probably the biggest point of my talk yesterday was there was this great cartoon, and it showed a giant plane, like a double-decker jumbo 747, and the top was the elite, and the middle of the plane was the wealthy, and then hanging on to the landing gear was everybody else. And it said, your view of the landing depends on where you're sitting. And so the people sitting on the landing gear, they're going to get squashed. The people at the bottom of the plane, it's going to be a little bouncy. But the people at the top of the plane drinking champagne, they love this guy. He is their hero, because stocks have rebounded. Nvidia's up a lot. They love that because that's what they own. The average person doesn't own any stocks. This is the crazy part. 49% of people in this country don't own stocks. That's just a crazy stat. What they own is houses, and houses are falling. And why are rents sticky? Well, to your point, people who have to move, which is not as much as there used to be because of remote work, there aren't as many people being forced to move. But if you do have to move, right? Let's say you finish school and you got to move somewhere, or, your company transfers you or whatever it is, and you have to move. That's who's making these home purchases. So they're not zero. Apple's relocating their second headquarters here to Raleigh. So every house that goes on the market here is getting bought at crazy prices because there's 4,000 people being forced to move here. So, I guess they'll hire some local people, but it's a whole bunch of people moving in. And so I guess the part that I'm really struggling with housing is if your goal is to reverse, and now I'm going to go to Sinister Saturday, right? If the goal is to reverse this decades long trend of home ownership and get people to own nothing, right? You won't own a house, you'll rent. And there was an article yesterday. They call them guppies. There's something about, there's a term for it where young people have given up hope of ever owning a home.
U.S. stock investors are gearing up for a potentially tumultuous September, marked by significant economic data releases, a Federal Reserve meeting, and concerns of a government shutdown. Historically, September has been a lackluster month for equities, with the S&P 500 showing an average decline of 0.7% since 1945, making it the poorest performing month, according to CFRA. Recent weeks have witnessed increased volatility, with the S&P 500, which had gained nearly 15% this year, retreating more than 4% from its July 31st peak. This retreat comes in response to concerns about China's economic slowdown and a surge in Treasury yields, diminishing the appeal of stocks. Investors are on edge as the market approaches critical junctures, driven by rising interest rates. The forthcoming U.S. non-farm payrolls report, scheduled for next Friday, carries the potential to impact market sentiment. A stronger-than-expected employment report for August could revive inflation concerns, while a weaker one could raise doubts about the economy's resilience amid the Fed's rate hikes. Additionally, attention is focused on the consumer price data due on September 13th and the Federal Reserve's monetary policy meeting on September 20th, following Chairman Jerome Powell's recent remarks at Jackson Hole. In this uncertain environment, some investors are adopting defensive strategies, especially in sectors like healthcare. Meanwhile, they are monitoring factors like the government's handling of student loan payments set to begin in October, and the risk of a government shutdown if lawmakers fail to reach a deal by September 30th. Share your thoughts on potential worst-case scenarios and their implications in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.